This year certainly has been different in terms of how we would have wanted to approach some of those markets, given all the headlines, around tariffs and unknown parts of what could be, in a tariff related or tariff type of, trade war type market. The ability to apply, I think, what we've learned and what we've honed in risk management platform and oversight, as well as, really strong capital base and potential for diversification, is how we were able to really scale into these markets. And I think it would have been easier to do, maybe a couple of years ago when we didn't have, all the sort of headline ping pong going on. But, it's also allowed us to learn a lot of lessons and probably get, the experience that might have taken several years.
What were the drivers behind the rebranding of DV Energy to DV Commodities?
We started DV Energy, let's say, about 12 years ago, and really primarily we're focused on oil, refined products, natural gas, power, anything really energy related. As we started branching out, really probably 4 or 5 years ago, we realized that when we were talking to traders and different people in the, let's call it, greater commodity industry, a lot of people didn't realize that we were doing things outside of the energy space. So when we would interview candidates for, metals positions or softs and ags, things that are non-energy, but similar, types of markets and products, a lot of them were confused if they were, joining an energy trading firm or they were joining, a commodities trading firm. So we sort of came to this decision that I think our footprint became big enough in sort of, let's call it the non-energy sort of sphere, that the rebrand was sort of a better reflection of what our actual, like I said, what our actual footprint sort of looked like in sort of the overall market.
How are you adapting your strategies to tariffs and geopolitical developments?
We're really strong on the risk side. I think a lot of what we sort of pride ourselves on is the ability to, to risk manage across different types of products and certainly different types of markets, right? And U.S. natural gas, for instance, is very different than base metals, right? I think that's obvious, but where there are similar applications is things like volatility adjusting position, right? Obviously, if we're in a tariff or global trade war, the volatility behind a product is very different than it was previously. That exists across markets. If your average daily move is 1% and all of a sudden it's 5%, well, we have to shift how big our portfolio sizing is. I think areas like that, it's been, certainly not easy. I don't want to downplay that by any means, but I think it's been something where we can take, the experience that we've garnered in other markets and certainly over the years and refining sort of our risk management capabilities to apply and kind of get ahead of these types of scenarios. And I think that's probably the hardest part for a trader, especially in some of these markets that have been a little bit, quote unquote, more boring over the last few years. All of a sudden you inject all this volatility, and it's very hard sometimes for a trader to turn around and say, well, I'm used to trading X number of size, and now I have to trade 25% of X, and I'm going to get the same result. Fortunately, on these last couple, of headlines and things, we've had the right position size on to sort of weather, let's call it a 10 or 15% or 25% move higher, or change in trade arbitrage or whatever, move you're really playing for.
What does adding risk allocator to your existing liquidity provider role mean for your trading desks?
Really successful liquidity providers, whether they're in energies or greater commodities or flat price or options for that matter. I think you're sort of taught and ingrained a certain way of trading. You're there for the long term, right? You want to be there every single year. You want to obviously make sure that you're applying similar methodologies but adapting to the market. It took us a bit, just like learning anything else, in sort of applying that to risk allocation, right? You can't expect somebody to have a VAR allocation and only make money every single day, right? Or have an equity curve that looks like a market making book. Like, that's obviously a very different expectation. So it took some time for us to sort of reprogram ourselves in understanding what the opportunity set looks like and when to deploy risk and things like that. Over the last 3 years, it's been how do we grow sort of this risk allocation model, fundamental types of build outs of platforms that have real scalability and compete more with the bigger prop firms or the sort of multi-strats family offices that have been sort of in the space or trying to get in the space and develop over the last couple of years as well. Okay, let's take this really sort of hard line of risk management, soften it up a little bit, using things like context and all that to understand why, certain moves have happened and why that might have either been, positive or negative outcome, for our portfolio managers, and, really leverage that to sort of create our own style of how we risk manage and how we allocate capital to different PMs. And, I think we've done a decent job of sort of differentiating ourselves from some of these larger sort of multi-strats and hedge funds, which I think risk manage a lot more just on limits and, more black and white types of, maybe expectations or risk limits for that matter. And sort of, give ourselves maybe a small competitive advantage in that sense.
What operational or technological innovations have been critical in supporting your rapid expansion?
We pride ourselves on the fact that we've built everything in-house. What used to be an Excel sheet that was connected to several other Excel sheets and had a ton of VBA and things going in the background, we now really pride ourselves on having an internal platform. We can adjust and we can amend to how portfolio managers want to see the risk or what information flows and things they want to have access to sort of at their fingertips, and doing it in a way that we're fully in control.
How does expanding into European intraday gas and power fit your commodity strategy?
Those are areas of rather extreme volatility. I think a lot of that was accentuated by, I think, issues in sort of the credit side of things that really probably hadn't been addressed and were, theoretically uncovered probably, during those sort of periods of extreme volatility and really, price squeeze. And, I think what sort of transpired over the years, or sorry, the weeks and the months on that side are things that we've seen maybe in the energy space that, sometimes you have these really short-term shocks, right? And we've seen that, certainly looking back over the past 50 years, and things that are now, once in a decade are now happening once a year. So there's been a lot of investment in this area. I think you read about a new sort of, fund or prop firm that's trying to enter every 3 to 6 months. And these are businesses that we've built out in very similar fashions in different areas. So I think for us, it was a really natural extension of kind of what we're doing, where we're investing, certainly resources, but also where we have a lot of experience in managing and growing these types of businesses.
What are the biggest challenges and opportunities in 2025?
And I think the answer probably has changed several times in the last 12 months, just given changes, whether that's, what's happening in the US or what's happening abroad that might even be impacted by the US. So I think for us, it's taking this experience, continuing to build that forward, but the challenges come in, continuing to manage headline risk, right? And I think it's a really easy answer to give, but it's probably the most relevant in terms of, what's going to move markets and why. I think we obviously always have our ears out for, regulatory changes or especially dealing in, European markets and things that have slightly different regs and from the US. Obviously, keeping our ear to the ground on things that could immediately change our market are really important. But from things that are out of our control, it probably stays in sort of that political spectrum, being able to manage around the volatility and the risk premium that's entered the market in certain areas. But, certainly as we kind of talked about before on what happened in copper and things, being able to adapt to that really on a very short term and quick basis.